Welcome back to 7-Minute Options. Today I'm going to be putting on a trade in TLRY just to take advantage of the call skew. So we put on a position last week on TLRY, and then I thought about it over the weekend, and I was looking at it and I thought, you know what, there's got to be a way I can take advantage of this call skew because it just looks too good. And so just a quick recap here of the call skew. Right now the stock is trading for almost exactly $19, right? So it's right about 19. So if I go $10 out of the money on the call side, options are trading for like 72, 73 cents. If I go $10 out of the money on the put side, I mean, they're almost worthless. I mean, we're talking like 2 cents. And so this massive change is because the market right now is pricing these options expecting for TLRY to move up. So there's definitely a call skew in the pricing. And the odd thing about that call skew is that over the last 3 days, TLRY has been moving down. So that's Thursday, that's Friday, that's today. You can see the 3 red bars. So today it's already down $1, and the market expects a big rally. There's definitely huge call skew. And so usually this is one of those rare opportunities where I do buy a debit call spread because, I usually only buy a debit call spread is if I'm really bullish on a stock and I buy it for 3 months or 6 months or 9 months out. Or in this particular case, because it's just so cheap. And what happens with the call skew is if you look at the option pricing, the 24 strike, 25 strike, 26 strike, all these calls, they don't drop in value all that quickly, which means in this case, I can buy the 18 call, sell the 19 call. That's a $1 wide debit call spread, and it's only costing me 38 cents. And the interesting thing about it is that this already has, 99 cents of intrinsic value. In other words, okay, right now it has a whole dollar. So this whole call spread right now is in the money, right? If TLRY just goes sideways and expires at $19, where it is at today, or 1902, 32 days from now, this call spread is going to be at maximum profit. It's going to be worth $1. Because of the call skew, right now this is only trading for 41 cents. So I pay 41 cents and I can collect up to $1 at expiration. And so I'm going to do that. I'm going to buy this right now. But check this out. I pay 41 cents. And because this is entirely intrinsic, like the entire $1 call spread, the entire $1 is intrinsic value. I am buying $1 of intrinsic value for 41 cents. Right? And so when you buy $1 of extrinsic value for 41 cents, your buying power actually goes up. So I'm actually buying a debit call spread. My buying power is going to increase, right? Right now it's showing my buying power will go up by $62. This is actually really good. I like this. Remember, I don't need TLRY to go up. I just need TLRY to go sideways. TLRY can even go down a little bit. It can even go down to $18.42 right now. That would be my break even, right? It's the 18 call I will own plus the $41 I pay for it. So $18.41 would be my break even. So TLRY can even go down from where it is now down to $18.41 over the next 32 days, and I still won't expect to lose money on it. So I feel pretty good about this. I can buy it for right now for, let's say, 38. Okay, the price even dropped a little bit. Let's see if I get filled. The market's a little bit wide. There's a 5 or 6 cent wide market here, but there's a lot of people in this, so there's a good chance I'm going to get filled. And if I don't get filled at 38, which is what I'm trying to get filled at right now, I might get filled at 39 or 40. But again, because of the call skew, the call spreads are relatively cheap. And remember, I don't need this to go up. I just need this to go sideways. If it goes up, that's great. I can collect my money even quicker, right? The faster this goes up, the quicker my money comes in. But if it doesn't go up, that's perfectly fine. I'm trying to buy a call spread that's entirely in the money for less than half of what it's worth, right? This is a risk 40 cents to make 100 cents type of a trade. And again, notice that I'm not buying 5 or 10 contracts, just one contract. Keep it small, right? Remember, keep it small, keep it smart. Don't overload on a single position. And you never know where these things are going to go. There's a chance TLRY might turn around and drop $3-4 more, and that's fine. I can afford to lose the $38-40. That's part of the deal. There's always a risk with these things, but this is just such a good trade. This is like a great way to take advantage of the call skew. I think Chewy is another one that I was looking at last week that also has quite a bit of call skew, but let's just look at this one for a second. Let's see if I can. Okay, now it's up to 41 cents again. Okay, so I'm gonna up the price a little bit. Let's go back to 40, see if somebody fills this at 40. Because it'd be nice to get this filled. So maybe I'll wait another 5 or 10 seconds. If it doesn't get filled at 40, now it's 42. Now it's up to 1906. Like, oh, come on, 1907. Yeah, I just want to get this filled. I mean, even if I pay 50 cents for this, it's good, right? I mean, okay, there we go. So I got filled at 42 cents. And in theory, I could wait until this thing is worth $1, but it's not gonna be worth the maximum value of $1 until the very last minute on the day of expiration, 32 days from now. I'm perfectly happy just closing this position and selling this for 100% gain, which would be $82. But remember, I want to pay for the transaction cost, so I'm gonna go 84. So I'm gonna double up my 100% plus the extra $2 will pay for the transaction cost, because I'm opening 2 positions here, like 2 options, which is $1 to open each one, it's free to close. So this is just a personal preference. Some people are happy with a 25% gain. Some people like to push it and go for 90 or 95. I would recommend not to hold this past expiration. I generally don't like holding positions up to expiration, especially if they're in the money. Because if they're in the money and one of them gets exercised and one of them doesn't, you could be in a potentially awkward situation. But I generally don't like to hold options through expiration if they're in the money. That's just, again, personal preference, just because it can go sideways on you. So I definitely like to exit. And again, I'm happy taking the $84. I don't want to wait. If the $84 comes in the next 20 days, I don't want to wait another 10 more days just to get the last 10. I like to close things out 15 to 20 days before expiration. This is no different. And really, we're only 32 days away from expiration, so I'm hoping that I'm only going to hold this for another 15 days, maybe 17 days or something. But anyway, so that's the plan. I can sell this for 84. That's my GTC order. And I'm excited. This is already in the money. This is all intrinsic value at this point. And so, yeah, I feel pretty good about this one. Let's see where this goes. All right. Thanks. Bye.